If you're close to the money, you know, like an oyster farmer, I eat 100 oysters every week. How many people eat 100 oysters a week? Well, I eat them because they're there. If you're in the business of making money and moving money around and counting money, and it's in the units of trillions, of course you're going to make more money. And then you become so isolated from the real working world of the average person who doesn't have this ability and is struggling to make it, to keep his job, to pay his mortgage, to, you know, feed his kids and send them to school.
It's the best part of my job. See, the white shell, no disease.
Making a lot of money is like taking a drug. You feel good head to toe. It is very similar to a drug. When somebody hands you $1 million check or a $5 million check, you want more. Yes. Oh, if I'm making $5 million, I should be making 50 because I'm a genius. No question in your mind that you are a genius, and that the rest of the world owes, you know, you're just so much better than everybody else.
A bottle of beer is £1, but you're having a party, so you need to have 100 bottles of beer. So how much is 100 bottles of beer? One bottle is £1. Tell me, how much is 100 bottles of beer?
100.
No.
Paul Wilmot, ook wel de slimste van alle quants genoemd. Wiskundige en auteur van vele handboeken. Een kwantgoeroe die al jaren waarschuwt voor het gevaar van een door wiskundigen ingezette ineenstorting van de financiële markten.
You go to the shop and you try and buy 100 bottles of beer, you may get a discount. They may say, okay, you know, for bulk. So one bottle of beer is £1. 100 bottles is not going to be £100. It might be £80. And that's an example of non-linearity. You don't just multiply the 1 by 100. Or it could be that the shop that you're buying the beer from, it's late at night, it's the only shop that's open, they know that you need 100 bottles and they say, oh, I'm sorry, we're only allowed to sell one bottle of beer. But if you give me £200, then okay, you can have 100 bottles. So it might be 80, it might be 200, but it's not going to be 100. And that's the real world. But that's not in 99.9% of finance models.
A quant is somebody who uses quantitative techniques, mathematics, statistics, computer science to try to model the value of financial securities and how to structure them, how to hedge them.
Emmanuel Derman, ook wel de Einstein van Wall Street genoemd, was ooit een kwantpionier die als theoretisch natuurkundige voor Goldman Sachs ging werken. Nu leidt hij nieuwe quants op aan Columbia University in New York.
I moved to this field in 1985 when there really weren't a lot of them, and it was sort of a free-form business. We were all amateurs. Now you can be a professional quant, but in those days quant was sort of a derogatory word. It was a bit like geek, sort of, which is like, I don't know, slang for sort of computer nerds or computer geeks.
There's a lot more respect for quants now. A decade or so ago, they were seen as these very geeky types who didn't really understand the business. Well, they are the business now.
Manhattan, New York, a beautiful and powerful place where I have a tremendous history and roots, but also a city where money places a heavy hand on daily life, now more than ever. I used to be a computer programmer at a major player on Wall Street that is no longer among us, for obvious reasons. I was creating the plumbing of finance. I would write not the models themselves, but the infrastructure surrounding the models. I could do it sleeping. Some of my coworkers were self-satisfied, complacent, with a lazy state of mind. In my better jobs, I got to sit on the trading floor, which was energizing. Most of my career, I sat in a nondescript cubicle form. But I was physically close to the quants, the structurers of CDOs and similar products, the traders. I saw what they were doing, and I felt attracted. They seemed to be solving difficult problems and working at the center of the action. I felt like I was looking in through a window, watching, yet separate. This really made me want to do the job. The pay is good, too. Just as they view the market itself, different employers have different views on these topics. I don't want our agreement or lack of agreement on these issues to be a factor in my job search. That is why I decided to stay off camera and anonymous.
One of the first ever equations in finance that I derived is still one of my favorites. Beauty is having the right level of complexity, but not too much. The key thing about this is it looks very simple, but having a modulus, an absolute value sign, it makes it what's called non-linear, and that in itself is very nice. And one of the problems with finance at the moment is almost all the equations you get are linear, which is boring and not realistic.
What financial models do for the most part is ask you for some input, like what will interest rates be in the future, or how volatile will interest rates be in the future, or what will prepayment rates be in the future, and then tell you what something will be worth today or later. And financial models always ask you for some view of the future and then translate that into a price. And so they can't predict things in an absolute sense. They can only predict things given your view of the future. And people call that prediction, but they're putting the input into there.
So in that sense, it's not a correct word, prediction.
Yeah, I don't think it's a correct word. And people like to say that this great financial crisis, global financial crisis that took place is a consequence of bad models. But I don't think, I mean, there are a lot of things that caused this, but I don't think models are by any means the major part. I think it's much more a question of incentives and the way the whole system works, rather than somebody foolishly relying. I mean, there are people that foolishly relied on models. Nobody can predict with accuracy how people are going to prepay their mortgages in the future, or how many companies are going to default on their bonds. There's always some view that's driving a financial model.
Well, my models, I wrote a piece of software that you brought in all the elements, the mortgages, what your assumptions about defaults and prepayments are. And so when you achieve that sort of golden moment where everything works, it's the numbers are correct, it's easy for the individuals to use, you know, that is a great moment, because you will walk down the aisle, you see all the people using your software. You know, they may not appreciate all the work that went into it, but you know, and you see it working. And then in our case, we were able to sell this software to all the major investment banks in the world. I think we sold one to the ABN AMRO was one of our customers, and you know, all the European and Asian banks and the American banks.
Mike Osinski werkte bijna 20 jaar op Wall Street als programmeur van software die slechte hypotheken versneed tot aantrekkelijke financiële producten. Computerprogramma's waar banken miljarden in stopten en waar biljoenen uitkwamen.
But the input into these were all what's called prime mortgages, mortgages to people to people that had jobs. So they were secure, they were stable, people were making their mortgage payments. It then grew into this vast enterprise, and I guess maybe it started to blossom around the late years of Clinton, and that I left in 2000. After that, it just went nuts. They were issuing subprime mortgages, a lot of subprime. It was a policy of the government. Both Clinton and Bush agreed that the government should force the banks to issue more subprime mortgages, and of course the banks were totally in agreement with that, because they could, on a subprime deal, they would make 100 times the profit that they would on a prime mortgage deal. So they were very eager to issue these kinds of debt. Now, whether the buyers, the end clients for these bonds, really knew what they were buying is a good question.
CDOs actually are a fantastic instrument in the way that they take all these mortgages and package them up, and then you slice and dice so that each person can take as much or as little risk as you want. Fantastic idea, brilliant idea. If you're going to sell these things, you have to have a really big profit margin, because that profit margin, it may be profit margin, but it also is a margin for error. So it may have a theoretical value of this, but you've got to sell it for this, because this covers possible errors. And once people start competing with each other, the profit margin shrinks. That's what happens when there's competition. And then suddenly everybody's buying and selling CDOs, and it becomes the biggest instrument on the planet. And there's no profit margin, there's no margin for error. Combined with quants and quant tools saying, don't worry about it. And then, poof. Here I have to apologize to the planet. I don't know, should I apologize to the planet? I did warn about the dangers in credit derivatives and in mathematical modeling. It is clear that a major rethink is desperately required if the world is to avoid a mathematician-led market meltdown. What you're supposed to do, if you've got a warning, you're supposed to take your warning and write it in book form. You're supposed to write 300 pages about the dangers of etc., etc. I'm a mathematician. And what mathematicians do is they take something that is maybe 300 pages and they try and condense it into one equation. And that to them is beauty.
6:30 a.m. on my way to the library. We'll stay there for the next 12 hours. Today's work: menial computation, abstract manipulation of symbols by hand with a pencil, which could add up to another 25 handwritten pages. I like to learn new things, solve really difficult problems. I like the challenge of representing a portion of reality with logical symbols and systems. I must have been 13 years old when I realized that you could calculate the volume of a bowl by breaking it into smaller and smaller rectangles. The flow of crowds. I like to observe the motion of crowds and sense relations and forces that operate upon them. Heavily trafficked public space. Crowds appear and disappear with the rhythm of the daily schedule. I have the ability to see patterns in abstract mathematical symbols.
What's the obsession with this particular formula?
It was the formula that crashed Wall Street.
As a mathematician, it's a combination of the sublime and the ridiculous, I like to say. Sublime because it's got a lot of beautiful mathematics in them. But ridiculous because ultimately you have to use the thing. So it just relates the probabilities of defaults happening in two different things to the behavior of two companies kind of independently and then via what's called a correlation.
Is it a problem that I don't understand most of what you're trying to explain me?
You don't?
I don't.
Oh, we were really dumbing it down, weren't we?
Yeah, I did.
Oh dear. Suppose you've got one of these CDOs, and the way the CDO works, you've got let's say 1,000 mortgages, And all these mortgages are piled into this contract, and the risk is whatever. Key thing is you've got 1,000 different mortgages. And you have to model these 1,000 different mortgages. And within this copula model, there's an assumption for how these mortgages interact with each other. The relationship between Mrs. Jones' mortgage and Dr. Smith. How many correlations are there in a 2-by-2 combination of these things? The answer is 1,000 times 999 divided by 2, which is approximately 500,000. And how do you know? How do you know what these numbers are, these 500,000 numbers? You don't. So what the copula boys do is they say, let's assume the numbers are all the same. It's too complicated, let's just assume the number is 0.6. That's completely ridiculous. You've got a really complicated model there, you've got these complicated interactions between all these people. So that's from the sublime mathematical modelling to the ridiculousness of just saying they're all 0.6. More senior people in banks don't necessarily have a clue what they're doing, because all these quants have all these multiple PhDs, and the people above are just management types. They won't understand the technical ideas that the quants know all about, and that itself can lead to problems, because if the quant says something, well, what's the manager going to do? The manager just has to believe the quant, and you'll hear stories about quants basing their models on 4 or 5 years worth of data. And you think, 4 or 5, that's not really representative of the economic cycles within the housing market. And what's that going to do for your mathematical models? Because anybody who's over a certain age will know that, well, actually, house prices can very easily fall.
There was a moment, I remember in 2007, I had a friend in the business socially making a social call, and I remember she said the Fed has got to lower interest rates or we're all screwed. And I remember thinking, I sold all my stocks and bonds, and I thought, geez, this is really going to be a lot bigger than people realize. If you look around you, there's a mortgage on every house, there's loans on every car. It's a big market, your credit cards. And if it was failing, they kept issuing debt. People didn't realize. People wanted to believe that everything was always going to go up. I think they were blinded by the amount of compensation that they were getting every year.
They're clean. They're clean. Yeah. Yeah. No, don't bother.
I mean, these are huge numbers. To make millions, $5 million, $10 million, that's a lifetime's worth of money you don't ever need to work again. And everybody wanted that. I could quit working. This year, I made enough money. In 1 year, I'll never have to work for the rest of my life. And that was the goal of everyone, it appeared to me.
This is money, okay? And Espen's talking about making money. Every year you're making money, and then 1 year you blow up. Now, the difference between this being your money and it being a hedge fund is if this is your money, fantastic, you're making money, you're down here, you're bankrupt. If it is somebody else's money, if it's a hedge fund that does this, every year they're taking a percentage. They're taking some of that as profit, as their bonus, effectively. So they make some of that, they make some more, they make some more. All of this money they're putting into their own bank account. And then, when they lose money, that's their client's money that's lost. It's not their money. So you can see why it's very easy for people to abuse this kind of thing. I think it's fantastic that people who take risk should be compensated for taking risk, but only if they are actually taking risk themselves. Taking risk with other people's money, you should not get compensated for. I'm sorry, I don't know where that fits into economic theory, but taking risk with other people's money does not get rewarded. Sadly, though, it does in this business.
Okay, good. That's enough for now.
What about the white one?
There was a moment when I questioned why I was ever involved in Wall Street.
Get the ice. I need it right now. On the double. Ice.
That something I thought that people would be more judicious and more conservative in their lending. And I was involved in it, and I thought, well, wait a second, these guys are out of control totally. The piece of software per se, you know, that's a sort of inanimate object. Yes, people used it, but, you know, if people had used it and put good mortgages into it, it never would have caused a problem at all. But when you put, you know, mortgages that you have a fairly high certainty that people cannot repay, and that half of all the mortgages issued in a given year are that type of mortgages, yes, the industry has gotten out of control. Trillions of dollars a year basically went through that model. These bonds, within 2 and 3 years of being issued, went from AAA to unrated. I mean, just catastrophic collapse. A lot of trading firms that kept these the riskier pieces in their portfolio saw them drop to next to nothing. And given the leverages, the amount of leverage and the amount that the banks had borrowed, they were suddenly in a financial panic.
Saturday after midnight, still studying. I know long hours will not stop when I enter a future job as a quant. Because I was primarily a technologist, I did not fully understand what was going on. I think part of my motivation post-crash for becoming a quant is to gain that understanding, having been through the personal experience of seeing the destruction of my firm. Looked again at my resume that I put out there. The same headhunter called again today to see if I would like to take a job in my former field as a financial technologist. I declined again, of course. No invitation for a quant job yet.
People that are in the business right now probably refuse to talk to the public. If they were to talk to the press, they would be fired. So only a limited few people in the business have the option of talking to the press. Once you're in the world, right, I mean, your phones are ringing, you know, from the moment I woke up in the morning. And I remember, you know, a lot of these guys I knew quite well, and they'd try to wake me up, 6 o'clock. Oh, I thought you were asleep, you know, and you'd be up till 11 o'clock. You have to be wired, you have to be alert every second, you have to be engaged, and you have to be perfect, and you have to be right all the time. You know, the software fails, people lose millions or billions. It can't happen. You can't be wrong. You have to be perfect. It's a lot of stress. My wife was in the business with me. We both would wake up in the morning and describe similar nightmares. Phones were ringing and we couldn't answer them. And then we sort of grew out of that, and we both realized that we didn't know what day of the week it was.
That's Lehman Brothers. It's the new Barclays.
Barclays. Was Lehman.
Was Lehman.
On Wall Street, the
Went under.
report is brought to you by the up 1.6%. In London, the FTSE up 1.2%. So is the CAC in Paris.
Hey, Joel. Oysters.
Banking has completely lost touch with its purpose, its original purpose, and is now becoming dangerous. It used to be that when some of these derivatives were first invented, they were to help a farmer, for example, hedge the value of his crop. So he wasn't speculating on the price of wheat, he was busy growing it. Now there are more people trading these commodity derivatives than are actually involved in the production of the commodity, which is completely bizarre. I know quite a lot of people in this business who are feeling a bit jaded now. People are starting to ask questions. My nice friends are starting to ask questions about their role in society. You may be making lots of money, but is it something to tell your grandchildren? Oh, I was a banker. I was there when I caused the 2008-2009 crisis, etc. What are they actually doing with their lives? Or just moving this money around? This isn't necessarily such a business to be proud of.
I think that's probably plenty. 30, 35 pounds.
I think.
Responsibility is just not a one-way street. When it's successful, you're responsible. Well, you can't be unresponsible when the same item is a failure. You have to have some type of responsibility. I mean, I could say I wasn't, but I was involved. I made a very comfortable living, and yeah, I was proud of what I'd done. I myself never saw this kind of debacle.
Pretty big muscles, you see. They're a little wilder. This is a, you know, they're yellow on the inside too. Different color. A chef in the city loves this wild taste, you know. I only do it for one chef because if I did too many, there wouldn't be enough, you know.
The model is Hippocratic Oath. I will remember that I didn't make the world, and it doesn't satisfy my equations. Now that's obviously that's about having a mature appreciation that whatever you do, that the models are never going to be perfect. I will never sacrifice reality for elegance without explaining why I have done so. So it's a competition between the real world and the elegant world of mathematics, and sometimes the real world is just dirty. Nor will I give the people who use my model false comfort about its accuracy. Instead, I will make explicit its assumptions and oversights. Quants are asked the following by some trader. They're saying, well, look, you've just measured the risk in this portfolio. It's too big. Okay, quant, back to the drawing board. I want you to redo your numbers and come up with a smaller risk. It doesn't mean change the portfolio. It means change the maths to make it look less risky. People can use the models to hide risk. Though I will use models boldly to estimate value, I will not be overly impressed by mathematics. People make finance too mathematical. So mathematical that many people who have to implement the models don't understand what's going on. And once you have too much mathematics, it's difficult to see where the mistakes are. I understand that my work may have enormous effects on society and the economy, many of them beyond my comprehension. So this is a serious business, this is what it's saying. The quantitative finance, banking has become so enormous, it's outstripped all other businesses. And really it should just be a service for these other businesses rather than everybody is now working to essentially service the banks, is what it feels like. It's completely changed the nature of the world, all this banking. Again, so there's a nice little picture in the book of me and Emmanuel Dermond with our Karl Marx beards on, because obviously the inspiration was a kind of communist manifesto. You combine the Communist Manifesto with the Hippocratic Oath, and this is what you've got.
When I first came to the field, I was sort of optimistic about using quantitative methods on the financial markets, and I don't think they're useless, but I'm trying to think how to say it. I don't think you can use quantitative methods to explain markets either. People like Bohr or Einstein or Schrödinger or Feynman discovered things that seem to be God's truth almost, you know, even if they're not 100% accurate. And I don't think that's possible in finance. I sort of think it's an illusion. The world, the financial world and the world of people is changing the whole time. History doesn't repeat itself, whereas in physics, history repeats itself all the time. You can do the same experiment over and over again. So, I don't know, somewhere after 5 or 6 years in the field, I began to realize that it wasn't the same thing as doing physics. In physics, if you wake up in the morning and think of an equation or think of some theory, you actually have a small hope in hell that you might actually be right. But in finance, if you write down some set of assumptions and you look at yourself honestly, it may be useful, but you know it's not going to be right in some absolute sense. Because you're dealing with people, and people don't work that way.
Another weekend, trying to remember all the parts of the city I haven't seen since I started the course. Longing to visit art galleries, eat out every night, to live. The day at the library seemed to have more hours than the normal 12. Studying alone, with other people doing the same thing, I feel like a monk in a monastery. It's peaceful. The library is quite old. Sometimes we have to cover the air conditioner with old Soviet mathematical journals from the 60s. Once I dreamt of doing pure science, working on rocket ships, working at a small startup company. There has to be a way to be creative as a quant too, like designing new financial products and the math to price them.
Do you think it's always possible for people to express a worry they have about the things they're building or writing?
It's possible. People may not listen to them in the end. Most of these people are employees. People don't always listen to you. But yeah, it's possible to do it. And I think people should do it. And I think people who use the model should understand that. But I don't honestly believe that the models are responsible for what happened in the world. I think what's responsible for what happened in the world is that there've been an increasing number of crises since 1990, financial crises in the world since 1994, and every time people are used to constant growth and acceleration, and every time it slowed down, the government stepped in and tried to stimulate it again by lowering interest rates just like they're doing now. And so you get these sort of a rise and a collapse, and then people don't like the collapse, so they lend money cheaply and force a rise again. And each time the oscillations get bigger and bigger, and they're doing exactly the same. I have no idea what's the right thing to do, but they're doing exactly the same thing now, which is trying to stimulate the economy every time it looks like it stops growing fast.
It shocks me that, as a person who runs many businesses, that we can talk about an economy shrinking by 1%. It's awful. Growing by 1% is fantastic. There's a difference of 2%. How can that difference of 2% have such a big impact on the world around us? 1% plus or minus in my businesses, I won't notice. The economists, they think that they're scientists. So they come up with these, what they call laws. They're not laws. Laws of gravity, that's a law. Anything that Isaac Newton comes up with is a law. But when an economist comes up, it's just a framework, an idea. It may work, it may not. Sometimes it does. That's not a law. But they think they're laws. And so they build up this whole edifice of theory based upon this very shaky foundations. And they get all sorts of nonsense coming out of it.
Rinse these off.
Uh-oh.
I think that the natural world is something you learn to appreciate through a struggle. In the financial world, you know, money is a man-made phenomenon, right? It's like a game, right, where you make the rules. Well, money is a game that people make the rules for. But out there, the day-to-day activity is not about making money. The day-to-day activity is trying to grow an animal, a healthy animal, or a group of healthy animals. That's a big difference.
Ooh. That is beautiful, believe it or not. That is beautiful. The beautiful thing about this is it says that in the risk-neutral, now I've got to keep emphasizing, this is the risk-neutral version, where mu equals r. If it was the real world, if this was the real version, it would have some d mu dt's in it. Now let's do some manipulations. Now some of these manipulations are straightforward. 6 over z, in which case there are no z's in there at all, if you see what I mean. The d by d big T version, because we are trying to find the stochastic differential equation not for log z, so you're going to end up with mu minus a half sigma squared. Let me backtrack a wee bit here. And we have a stochastic differential equation for z. Then we can also write down the stochastic differential equation for f. There was a very, very short period of time when quants were in the doghouse, so to speak. The people were saying that, oh, banking is changed forever, quants have finished, there'll be no more of these credit instruments. And I said, hang on a second, guys, you really don't know your history. You don't know human nature. This will all blow over in a matter of months. And of course, we're back to the big bonuses. Everything goes back to as it was. If people don't complain now, then it serves them right when the next financial crisis happens.
12 hours to go before the evening classes start. I feel united with my classmates by the enormous workload.
It's actually the fees that we're trying to maximize, right? Of course, we have to maximize returns. We have to do a good job in managing their money, otherwise we're going to do pretty poorly at collecting those fees.
I wanted to feel challenged again and enrolled in a quants program. It cost me $60,000 tuition, which means more debt that I now have to take on.
The incentive fee structure basically means that maximizing the TWR is like maximizing fees. Think about that. That's kind of tricky.
This course is 1.5 years full-time. 1.5 years, no salary, expenses living in downtown Manhattan, plus paying full-time tuition. So no alcohol for me, not a drop, at least till the end of the first semester. I can't afford to lose a day to a hangover. Hardly any social life for the time being. Most of the other students are Asian or East Europeans. Math is their first language and our common language. We Americans are the minority.
Maximizing the number of times that we're going to penetrate the previous high water mark, we're actually maximizing incentive fees. So you can see that this type of optimization is very hedge fund-like. Does everybody get it so far?
Used to be the physicists were splitting the atom. Who's splitting the atom these days? Building bridges. Who are the people building bridges? Everybody wants to move into this field. Scientific creativity is becoming financial creativity, which is all a bit bogus. Quants are essential to modern banking because so much of it is based upon new techniques, like the latest thing is the algorithmic trading, the high-frequency trading, for which you need math skills.
It used to be, historically, you just have like floor traders and brokers, screaming and shouting down on the floor of exchanges and trading stocks, and the order came down and they would run up and they sort of muscle their way out and wear different colored jackets, the classic pictures we've all seen.
Matthew Goldstein, onderzoeksjournalist voor persbureau Reuters, die als een van de eerste de gevolgen van het high-frequency trading aankaartte.
The reality is so much of this doesn't even take place there. I mean, that's becoming such a lesser part of trading and what goes on. It goes on in the back rooms, and it goes on in these modelings where these programs are put together by computer geeks, basically.
So high-frequency trading is just about taking all this data, analyzing it very, very rapidly, and then putting on trades that may last milliseconds.
What worries me the most is I was disturbed to hear that some firms get faster access to the markets than other people. I forget what they call it now, but people get like a tenth of a second advantage, big firms, which I think is unfair.
Hedge funds try and get the black boxes as close to an exchange as possible, because it takes time for the signal to get from the black box to the exchange to buy or to sell. Now, of course, that is dictated by the speed of light. Now, we're talking about trading at the speed of light. The classic crash was the 19th of October 1987 crash. That happened within a day. Or the big move, the 20% fall in the S&P 500 was within a day. The next crash could be within minutes.
So what is a black box?
A black box is just something that has inside some kind of formula, maybe secret or maybe not, that takes in lots of data. And the data might be stock prices, it might be other information, and it tells you what to trade, what to buy and sell. and my favorite is Google search terms, trading based on what people are searching for.
It's not a black box in the sense that, you know, if you saw the algorithms, you could figure. Well, you and me might not be able to figure it out, but wiser minds maybe could, and computers can certainly read it. So it's a black box in the sense that it's almost hard for the human mind to get their arms or, you know, wrap themselves around to really understand what's going on. And you know, people have said for years that Goldman itself is a black box, because we don't really know how it makes all this money and the billions of dollars and, you know, the big bonuses we hear about. The New York Stock Exchange is building this big facility out in New Jersey, which is, you know, right near New York, and basically it's being built for high-frequency traders, so they can have their equipment very close in a very, you know, tightly knit factory, essentially, to do high-frequency trading. Well, who gets to have their server where? Is there going to be a lottery? You know, does someone pay more to get closer? I mean, it's sort of absurd when you think about it. This is what it's come down to. The battleground is ultimately going to be who has the most resources, who can pay the best salaries, the hire the best brains. And in reality, we're talking maybe about a dozen or so really top players. You know, and not everyone can be a customer of Goldman Sachs. Not everyone can be a customer of Morgan Stanley or, you know, Barclays.
Also, it does, the high-frequency trading means people are more concerned with the price of something and not its value. Value means what it's really worth. Price is just what people buy and sell for. And if you buy something now, sell it a second or two later, all you care about is the price you sold it for is greater than the price you bought it for. Its actual value, who cares?
It sort of flies in the face of what we sort of think about what the markets are really about. The companies themselves almost don't matter, and what they do doesn't matter. It's just the fact which way their stocks move is all that matters. And what's sort of frightening about it that I've seen from the standpoint is the systemic risk that might be involved, that so much of this trading just takes automatically and just takes place so quickly that the human element gets more and more divorced from it. I mean, the human beings are obviously responsible for writing the programs, but there's no human being interstepping between these trades. And we saw this a year ago with United Airlines. There was a false bankruptcy rumor. Some wire service inadvertently had transmitted an old story about a UAL bankruptcy filing. The problem was all these news-reading algorithms saw that and immediately started sell, sell, sell. In a matter of minutes, United Airlines stock is cut in half. That is clearly a case where the computers have gone wild.
Banking is taking over the entire planet and is having such a major impact on the man in the street, and it really should not. You know, banking is supposed to be to take money from people with too much to give to people with too little who maybe want to start a business, they've got a business idea, but that's not what banking is about anymore. Banking is just about gambling on these numbers, not realizing that behind these numbers there are human beings with jobs.
There's always been a joke about the New York Stock Exchange becoming a museum at some point, and they'll just have it for like a show there and people running around. And this is the way we used to trade stocks, you know, isn't it so quaint and everything? At the same time, one can argue, though, that if there's this big backlash in high-frequency trading, we may see a revival to some form of human element inside, that people may say, you know, as flawed as human beings are, we don't want to give everything over to the machines either.
Just walked past a crowded Wall Street full of Chinese tourists, asking me if this was the actual stock exchange. Wall Street as a location is not any longer what it was. Many banks moved their front offices uptown and their back offices to newer and cheaper spaces in New Jersey. Now Deutsche Bank is the only major firm left on Wall Street proper. Nearby is Goldman Sachs, with no name on the door, also about to move. There are almost no large firms headquartered in the neighborhood that was the cradle of American finance. only the New York Stock Exchange remains. Its facade, one of the most iconic symbols of global capitalism.
I'm always trying to encourage young people to do what I'm doing. I mean, it's a young person's, you know, it's pretty physically intensive. They really haven't grown that much. I may not make it till Christmas here. You know, I like a bigger, we typically sell a much bigger oyster, right?
What do you find more satisfying?
Well, software is a much more mental, you know, the pleasure, the mental exertion is pretty intense. Like 1 million lines of software is a lot, and you have it all memorized, right? And there's the pleasure of like a Scrabble, doing that kind of word puzzle kind of thing. Although it's not that healthy. You sit in front of a machine, you have the terminal face effect, you know. It's not the same as this.
Oh.
You know, this is pretty...
Not good.
I mean, a day like today is pretty idyllic, right? You're just out in the water, the nice feeling bringing food in. So I think we sell about 150,000 oysters, which is, that's $100,000. You know, of course, I live off interest, you know. So this is nice to have, I make some pocket money, et cetera, et cetera. And the overhead here is pretty small. You have to come to grips with nature. Like these oysters should be bigger. Every year, the ones that I pick in September and October are ready by November. Why they aren't, I don't know, and there's nothing you can do about it, right? Where in software, you can do something about everything. You can modify, you can make, you know, this virtual world, you can make what you want. Here, you know, you have to live constrained by, you know, the real world.
On May the 6th, 2010, at 1400 hours, 42 minutes and 44 seconds, the US stock markets go into free fall. Dow Jones takes the fastest and most dramatic nosedive in its history, an event that will be remembered as the flash crash.
Where are you on May 6, 2010?
Here working. May 6, 2010. Yes, I was here.
I spent all day, literally locked away on holiday, looking at the British general election.
1053, so 90 handles? That's too much. That's way too much.
I was on a conference call with a potential investor. One eye on the market, one eye on my own profits and losses, and then my ears and mouth doing whatever else they have to do. And the market's basically looks like it's going to go to hell that day.
It was the first really down day that we had in a while. And I remarked to Dave, let's just stay on top of this because this could get really ugly.
So 40 minutes in, we're in the middle of a great conversation, and he says, look, I gotta go. We'll talk again. This was really interesting, but I have to go now. And I watched the market fall another, 2 or 3% from there.
It wasn't just minutes later. It was Armageddon.
Here you go. I'm told it's 835. The Dow ticker. Wow, almost 1,000 points. We call this a capitulation.
I was just opening up my computer like most everybody and going, oh my God.
I'm shouting to my colleagues because I have a giant TV in my office gawking at the screen. Like when the Dow hit nearly down 1,000 points, you're like, really?
87 evens are trading, 86 evens are trading, 85 evens are trading here now, guys, all the way down.
And people didn't know why it was happening. And there was rumor after rumor after rumor, and it kept on getting worse.
I saw that panic, you know. Then I started watching CNN or one of those channels.
What we're seeing right now, I mean, I believe maybe unprecedented. You're not didn't talk about capitulation. Let's take a look at P&G.
They're gonna probably halt trading. We can't stop the selling.
I don't think I found out about this in real time, so this was probably a half an hour later or an hour later. There's nothing that one can do in the middle of the day, so there's no button that we press that says, hey, stop what's going on, so the markets are going to move the way that the markets move.
It just didn't fit the facts that there was some big global news story. It looked more like an error or a bad price. That's what it looked more like at first.
And then it got magically better. And nobody had seen a recovery that quick either.
It was a little bit like seeing someone hit by a car, or you see some terrible motorcycle accident, you know, the guy must totally be dead, and then the person gets up and walks away.
No, the market didn't work. It broke down. The machines broke down. That's what happened. You know, Procter was never at 47.
That to me is the mystery. I mean, I think it really, we don't understand these things. This is really the earliest form of digital financial instrument.
George Dyson is a historian who has just completed a decade of research into the development of one of the first computers.
What I'm doing now is carving the data into this stick. This notch represents 100 pounds of gold. These go back to the 12th century. And these smaller, there's a 20 pounds and 10 pounds. Now it breaks into two pieces that are unique. This part stays with the exchequer, with the king's treasury. The person who brought the money keeps this part, which is of course called the stock, and that's the origin of the word we still use of owning stock in something. So if you put money in your bank or something, you're essentially getting a number that is uniquely matched to the money that's in the bank. And if you come back and say, I want my money, you get it. So it's the same principle, it's just moving a whole lot faster.
On the morning of May the 6th, the sun rises in Asia and all is still quiet on the financial markets. But the British elections and the continuing concerns about the Greek financial crisis are causing anxiety. When the American exchanges open, prices are under pressure. At 2:45 p.m, many shares, including those of Apple, Accenture and Procter & Gamble, collapse.
So you've got the general picture, the big picture, although it's still over a very short time scale, and then you've got the detailed picture of the individual trades. See, there's a little bump there. That's almost the more natural scale, whereas even here at this level, it's something that seems to be quite big. So there are some trades that are kind of normal, and then there's yeah, it's funny, these big, you're right, these are really big, aren't they?
So can you explain this?
You can explain it.
Paul Wilmot is a mathematician and quant who is privy to the algorithms used by the automated systems driving the financial markets.
The thing that's sort of easier to explain is in the zoomed out scale. And you can see this nice falling off a cliff and then bouncing back up thing. What's harder is these spikes, the trades happening down here, but every now and then there's something up there, which is...
And the differences are in nanoseconds.
Enormous differences. But what's causing it I don't know what's causing it. But this one it starts off at 42 and it goes all the way down to 1 cent. Lord above, it's amazing. It is better to fail conventionally than to succeed unconventionally.
Wilmot gives classes to traders, hedge fund managers and bankers. For years he has warned about the dangers of an algorithm-induced collapse of the financial markets.
Oh my gosh, I turned away when that happened. So who is it selling Accenture at 5 cents?
It has to be a machine, right?
Yeah.
Essentially they're just rocketing back and forth between.
Yeah.
Only a machine can do those, right?
Any thoughts of what's going on here?
Steve Jobs didn't die. There's no reason for Apple to be falling to zero.
Right.
And so they start trading, and then, I mean, the back up in, 7.5 minutes or something, it was incredible. And that couldn't have been people not reacting that quickly and not in that kind of volume.
Well, one key thing is how automated is all of this, all of these trades? Can you identify that this was caused by some black box thing, or was it somebody in the old-fashioned way picking up a phone, etc., and making a trade? I've got in my head a scenario where there are no people at all anymore. There are black boxes, and they're really clever black boxes designed by famous banks that we won't name, and not so clever black boxes. And one day, the clever black boxes decide to stop trading because they don't like the numbers that are coming in, leaving you with the quite dumb black boxes that'll do basically anything. Accenture should not be selling at a couple of cents. I mean, it just doesn't make any sense at all. So if you're just left with a bunch of dumb black boxes, they could be doing anything.
You know, the Vatican selecting the Pope is maybe a pretty black box kind of a process. They take in inputs about the candidates. God knows what they do in there, and then there's some chimney smoke, and boom, it's done, right? There's your output.
Rishi Narang manages a fund investing in a global network of high-frequency traders. He is a strong believer in automated financial markets.
So it's any process, whether systematic or not, that has inputs and an output, but where the process of transforming the first into the second is unknown or unknowable.
So a black box is a box. I mean, these modern black boxes are boxes that sit at the stock exchange and has some rules or algorithm. I mean, it's concealed within the box that decides on Wednesday I'm going to buy this stock and on Thursday I'm going to sell it. So we don't know what's in these black boxes, and that's really the interesting thing. That it's like essentially a poker game where you can't see the opponent's cards, but you know how much they're bidding.
So this is a big financial service firm here.
So no name on the door.
Nothing. You would never know what's going on here. As you notice, it's guarded, gated. There's cameras everywhere. They probably know that we're here right now. So in a period of time, they would come out and say, "What are you doing? Stop doing that," type of thing. And if you rolled up and said, "I'd like to come in," they would not let you in.
Jeff Hipsman, once employed by Wall Street investment bank Lehman Brothers, now works as a data center broker for the world's leading financial companies.
And obviously, and also no signage, so you don't know whose facility this is, you don't know what's going on inside of it. Completely a nondescript building.
No windows?
No windows. If this building has a problem, if this building is damaged, if anything happens to this building, they run the risk of not being able to execute trades. So they protect this. This is the heart and the lifeblood of their business. So imagine your home where you have double everything, double power utility feed coming in, 2 refrigerators, 2 washing machines, 2 televisions, and if something were to break, you can go immediately to the second device. In the data center world, that's called a Tier 4 facility, and what they need is 2 of everything, because the cost of downtime to these organizations, if they're not able to trade or they lose trading operations for seconds, it could cost them an enormous amount of money. Some of these firms take it to the next level where not only do they have it with a duplicate within a facility, then they have a second facility that's exactly the same. The goal of these facilities is to minimize, if not eliminate, any single point of failure. New Jersey is a very hot market for data centers because of the distance issue to Manhattan. When you're dealing in milliseconds, there can be absolutely no delay. Being that the technology has a limitation in terms of how far away it can be in terms of that latency, it's based on the speed of light between one point and another, that distance becomes your outside ring, your outside distance that you can go. Tends to be in the neighborhood of 30 to 35 fiber miles. So we're constantly tracking the fiber as to where it is and what the main routes are. And we also track where the power is, because another main component of these facilities is they are very heavy power users. They need an enormous amount of electrical capacity in order to operate. We don't want to have any outside event cause an outage in the facility. These may be things like highway access. Can a tractor trailer accident cause an evacuation of the area? We look at flight patterns. We look at floodplains. We look at nuclear plants. We look at rail lines. We'll look at crime levels. We've looked at lightning strikes. The goal is to eliminate any possibility that one event can cause an outage in the facility. So a typical facility could be anywhere from $300 to $400 million.
You know, the wealth can be distributed evenly or wealth can be distributed unevenly. And wealth can be distributed unevenly among people, and it can likewise be distributed unevenly and evenly between people and machines. I mean, all the money is flowing to the computers, and the same with these stock exchange facilities in New Jersey. The money is flowing through these points, and the machines are surrounding it, just sort of siphoning away that wealth. But if you go into the neighboring communities, the people are really very poor.
High-frequency traders are estimated to generate more than half of the entire equity trade volume in the US. Traders, or rather computers, making money by buying and selling within a matter of milliseconds.
If you think about the market and the center of the market being the innermost circle, the specialists or the market makers at the exchange members, and then there are these concentric circles as you go further and further out, and the last circle is some mom and pop investor that's not in a financial center. They're in the middle of a farming country or something, or farmland. The speed that the highest frequency trader knows something and can act on it before a discretionary trader sitting on his farm and his home PC is now a matter of a second or two.
Does that also mean that the high-frequency trader has to earn his or her money within these two sections?
Yeah, it does. Yeah, because by then the rest of the world is processing the same kind of information. They call it the race to zero because zero is the amount of latency or delay. So if you think of this in a really metaphysical sense, in the actual market, an event happens. Someone raises their bid from $100 to $100.01. How fast can you actually receive that information? That's the first question. The second is how fast can you process it? And the third is how fast can you get your decision back to the marketplace to act on, right? So this is why speed matters.
I'm interested in the origins of the digital universe because it's this world that affects us all now. I mean, we live in this digital world, and I'm interested in the beginnings of things. How did it start? So this particular computer that I've spent so much time interested in was not the first computer. But what's important was it was the first randomly accessible electronic memory. That's the critical thing. The size of this matrix was 32 by 32 by 40 bits. So that's 5 kilobytes. That's now the memory we use to display an icon on our desktop. And I think in an MP3 it would be half a second of MP3. That was the size of this universe they created. Up until then, numbers represented things. You'd say, well, I have 10 oranges or 10 apples, or the temperature is 10 degrees. Now you had numbers that were order codes that could actually execute instructions in the machine. So numbers were allowed to do things. These are the crew of the guys and women who really made it work, the engineers, machine shop people, the women who did the coding. And their name for it was MANIAC, Mathematical and Numerical Integrator and Computer. On the MANIAC, they did the calculations that led to the first hydrogen bomb test, which was called Ivy Mike. You can't just build a small hydrogen bomb and see if it works and then build another one. It has to work the first time, and nobody could. I think they could have done it by hand, but it would have taken 20 years. That's what's, I think, so profound about this financial thing, because suddenly it used to be, well, this is sort of interest to people, designing nuclear weapons or studying the spectrum of light coming from stars. I mean, who really cares about what happens at frequencies of a billionth of a second? It really only concerns physicists. Now suddenly, it concerns all of us, because it's gone into this financial world that represents all our wealth.
I only see 570. Why isn't it updating? All right, we're in bear market!
On May the 6th, 2010, at 1400 hours, 42 minutes, 44 seconds and 75 milliseconds, an E-mini future traded on the Chicago market begins to show erratic price swings. The fluctuations affecting this E-mini, an important indicator of market moods, soon spread to other shares within the US, ultimately leading to the fastest and most dramatic fall of Dow Jones ever. Nearly $862 billion go up in smoke, albeit briefly.
There were two things that stood out a lot. One was the speed that the market initially plummeted.
Greg Berman, a Wall Street veteran himself, led the investigation into the flash crash from SEC, the US financial market regulator.
So for broad indices to plummet multiple percent, 3, 4, 5% in a matter of a minute or 2 or 5 minutes, that in itself is quite extraordinary. The second aspect that was even more extraordinary was the number of stocks that were affected and the depth that some of these fell to. So when you see large cap stocks fall 60, 70, 80, 90%, that was quite dramatic. At that time, what we didn't understand, and again, we're talking about just 2 to 3 hours after the event, is how can stocks trade for a penny? How can stocks trade for 1/100th of a penny? Who's buying and who's selling down there?
So when this E-mini drops, then the SPY drops. Well, the SPY is made up of 500 different stocks, and then all the stocks in there are members of indexes, different indexes, and so they'll reprice, and then the whole mess has options on top of it, and for SPY, it's pretty much all the options, so those all have to reprice. So you're trying to reprice all this stuff in 50 to 100 milliseconds, and the system cannot handle that.
Evanston, a city just north of Chicago, is home to Eric Scott Hunsader's company. Hunsader is a data analyst whose company collects, purges and sells financial data. On May the 6th, he received urgent reports from clients complaining about incorrect share price information. The markets could no longer sustain the massive data flow produced by this flash crash.
And that's when the delay started, a few hundred milliseconds, and then a few seconds, and then 5 seconds, and then 10 seconds. And then some of them went all the way to 36 seconds.
So the delay in the data was 36 seconds.
Right, but the way that the timestamps occur is it hid the delay, so you couldn't see it. The Dow Jones, it was actually should have been here. The real price was here. The delay in the system caused it to appear like it was over here. So when people were seeing the Dow dropping, this was actually really where the market was at that moment in time.
What we're seeing right now, I mean, I believe maybe unprecedented. You're not talk about capitulation. Let's take a look at P&G. All right, this is going to say everything. P&G is now down 25%.
Well, that's true. If that stock is there, you just go and buy it. That can't be there.
To watch people talk about a major business news channel who have seen markets day in and day out, and they didn't know that this market had already turned and was flying higher. Something's not right. You should at least be able to know that you're behind. I mean, it's one thing to be behind, it's another thing to have no idea you're behind.
Long before the SEC report came out, Eric Hunsader had published his first findings on his website.
We're the ones who pointed out NYSE was delayed on May 6th, and they testified that they weren't a couple times. So, but, you know, the SEC report said it didn't matter, so I guess it didn't matter.
But if your clients are experiencing...
It sure matters to everybody I know that trades. That's, you know, the name of the game is getting the data faster. And they're requiring everybody who connects to them to have a 1,000-foot cable. No matter if they're 10 feet away or 50 feet away, because they all would fight over who was closer. So a 1,000-foot cable, it takes the speed of light 1 microsecond to go down a 1,000-foot cable. So if somebody had a 500-foot cable, they would get 1/2 of 1/1,000,000th of a second faster. But latency doesn't matter, does it?
Only those financial institutions that used the much more expensive direct data link to the New York or other stock exchanges received the price information without the delay that could run up to 36 seconds.
This is the NASDAQ exchange. Let's see the exhaust from the generators. And then the louvers are the air intake. So they've got 3 in place and looks like they have a slot for another one.
So it's being constructed right now?
Right. Right. You see security, they'll have gates around the whole thing. Their generators are in the back. And then this is another financial service firm.
So no windows?
Nope. So we can go through until they yell at us. This is their cooling systems right back here. You can see the generator exhausts in the back. And then you've got security gates. I don't want to get these guys freaked out when they see a camera.
And is there a reason that they're so close to the NASDAQ?
No. They were in first, NASDAQ came in later.
It is possible for hedge funds and banks to make money from all this volatility that we've got in here. Let me stop. Suppose somebody bought here and sold here, they just made a fortune. And they could retire on that. Accenture, when it's down at cents, a few cents, when normally it's up at $42. I don't know who was doing that. It would be nice to know.
Maybe not a who, but...
Or what, indeed. Yes.
Yeah, if you had GE, that'd be really interesting because the bid would be higher than the ask.
Yeah, you see that happening here also.
Oh, yeah, right.
At a certain point.
Because they got behind 5 seconds ish. Yeah. Yeah, there you go.
So what do I see there then?
You're seeing one exchange is their bid price is higher than the other's offer prices. So you could buy it on the lower one and sell it on the higher one immediately and capture that profit.
You don't want that to happen. You don't want it to be the case that the S&P is 1,000 points here and 1,020 points there. It's the same index. It should just be 1,000. Okay.
How do you mean? I don't really get it.
So let's say I can buy the S&P here for 10% down on the day, but I can sort of sell it here at the exact same moment for 8% down on the day, I've made 2% with zero risk. If you have the exact same instrument priced differently in two places, that's free money.
This opportunity actually existed, so people could, and they were, buying one and selling the other.
So that's making money of the malfunctioning of the system?
Yes, yes, it's arbitrage.
Guys, once again, 75 even offer here now, guys. 70 even offer. Guys, this is probably the craziest I've seen it down here ever.
Even though it was a 5-minute flash crash, it took 5 months for us to do the full investigation. The first is we had to organize. So we developed and deployed a multi-divisional cross-functional team, a big team consisting of people basically from every division at the SEC. We also coordinated with the CFTC because this was a joint investigation, and they had a multidisciplinary team on their side as well. We had to basically reconstruct and understand what happened, what's the order that events happened in, and hopefully from that, we'd be able to determine why it happened.
While the SEC was assembling a multidisciplinary team, Eric Hunsader continued his own research into the market delays.
So what are we looking at here?
I wanted to show how an order that comes into an exchange, how that price gets transmitted to all the other exchanges. So I built this model and represent each exchange by one of these boxes, and the prices in each one of these exchanges shows how that exchange sees the bids and offers on all the other exchanges at any given moment. This is just for one stock. There's a lot of information that occurs in the marketplace. In fact, if you were to take the first second of trading for all equities, options, futures in the United States, and you printed it on a sheet of paper so each line was a trade or a quote, the first second of data would be a stack of paper about 6 feet high.
1 second?
Yeah, one second would be about 6 feet high. It boggles the mind. Like on that day, it was we had 7.6 billion data points. You know, a billion is a big number. So we take data from all the exchanges. We save it, archive it, so that we can replay any day exactly as it occurred whenever we want. It would look to us like nobody was finding what was going on. I said, you know what, we are in a unique position to actually probably figure this out because we can play this, you know, we can just throw everything at it and see what's unusual. And so that was the thing that sucked us in, really.
5 months after the crash, the SEC report was published, identifying the cause of the flash crash as an uncommonly large order from an investment fund for the immediate selling of 75,000 E-mini contracts with a total value of $4.1 billion. Long before this report was published, it had leaked out that the source was the Waddell & Reed Investment Fund, based in Kansas City.
So how far are we now from Wall Street?
We are 1,000 miles, and we are culturally 1,000,000 miles from Wall Street.
Bill Black, a financial regulator back in the 1990s, now works as a professor of economics and law at the University of Missouri in Kansas City.
Kansas City became important as a matter of finance because it became important as a matter of agriculture and as a matter of foodstuffs, especially meat. It was the place where you came from Texas in all those Western movies with your cattle because the railroad was here and because the mighty Missouri River was here, and that's what made commerce so easy. Railroads had all this right-of-way and nice straight lines where you could lay the very sophisticated cable that allows you to transmit enormous amounts of information very quickly and very cheaply and very reliably.
The question remains whether it was Waddell & Reed that, by using these cables to place its major selling order, caused the US stock markets to plummet.
Are we at ground zero?
Is this the place that triggered the flash crash? Well, the Securities and Exchange Commission in the United States and many other people say, yes, this is where it all happened, and that it was triggered by some trades, roughly $4 billion, by Waddell and Reed in a particular index.
One of the things that I think people find hard to believe is how can any order move a market? A lot of the trading that goes on is market neutral. I'm trading with you, you're trading with me, back and forth, back and forth. Tremendous amount of volume, but neither of us hold more than a small amount at any given time. I sell a little, I buy a little. I sell a little, I buy a little. I sell a little, I buy a little. And then someone comes along and they say, I sell a little, I sell a little, I sell a little, I sell a little. So wait, so that completely changes the dynamic. Where's the buy part? The behavior of all of the market participants changes because of this very, very large trade.
Waddell and Reed says it wasn't us. And what can Waddell and Reed do, right? The more they talk about it, all they do is create publicity. And so they haven't followed that strategy.
Yeah.
Good evening.
Hello.
My name is Josh Fischero. I'm the security guard at Waddell and Reed.
Yeah.
Waddell's they don't like to talk much. But internally, as humans are, some of them who are much closer to it are like, we can't take this anymore. And so they had seen the analysis that we had done, and they said, would you like to look at our data? And I was like, yeah, send it over. I didn't really believe it was going to come over like that, and then sure enough, it did. And then I lined them up and saw how they was executed. That was the shock for me, because then I could cut through all the talk and just see the data, because the data will always tell you what happened.
If you just look at the data, there is always room for multiple interpretations. This is not a flash crash issue. This is, you take any data set anywhere, and you can have 5 people and you'll have 7 different opinions. This definitely resulted from that large trade and the way that large trade was placed. You can't see that by looking at just the information that I think other folks have looked at.
Wrote some software that took all the trades in that period of time, and I plotted it out to see where it traded. And I looked at it and I was like, so you see the red dots here?
Yeah.
That's the Waddell and Reed. These are where Waddell and Reed traded here. So all the blue dots are where they did not. You don't even see them on that one. They're not even there.
So then it's not there.
There's one little dot here, and there's one here and one here. Again, only when the market's going up. They only sell when the market goes up. They don't follow it or chase it down. So this algorithm actually is very sophisticated. It's extremely sophisticated. I mean, it would never sell at the bid price, for example. It would only sell when somebody was willing to pay that price, buy it. Just a couple here. Here they're selling it on the way up, and then it stops here, nothing.
In this case, what we were seeing is that the patterns were such that things were happening at the second and the 1 minute level. So we're able to take a lot of the quotes that were happening within a millisecond and aggregate them. So the data that you actually see in the report tends to be chunked up into 1 minute blocks. So you can look at it at the millisecond level, but the noise that you get in that millisecond time frame doesn't tell you much.
This is on a 100 millisecond basis. Because if you go out to a second, for example, then this will be averaged over the whole second, so it'll dilute it about 10 to 1. And if you looked at it at a minute, well, forget it. You would never see this, so it just wouldn't show up.
But does that mean to you that the SEC report is nonsense in that sense?
Well, here's what they missed. Okay, so this is when it came out. This is when we kind of had an epiphany. It says that the algorithm sold to buyers, and some of those buyers were, and I don't want to get myself in trouble with a whole group of people, so let's just say buyers. One group of buyers would accumulate up to about 3,000 contracts, and when they got that limit, then they would turn around and they would sell that position. And what the report doesn't mention is when they sold it, they didn't sell it like the Waddell and Reed algorithm did, which would wait. They sold it as fast and as furious as possible. This boom down. This is instantaneous. This is like in 50 to 100 milliseconds. They was sold about 125 to 150 million worth of these contracts. You have in here, and you have in here, and then here, and here, and here, and then boom. And so my question is, if you're going to name Waddell and Reed, or not name them, but name them, why aren't you going to talk about this? I mean, to me, those are very disruptive. In fact, they're so disruptive, that is what caused it. So this thing started, that's exactly when the market delays happened, and they just snowballed from there.
So it's one firm?
I don't know. I don't know. They would know.
Who would know?
The SEC.
They would know because for them the data are
They have. Okay, so all I get is time, price, a sequence number, and size. They get that, plus they get who did it.
There are some very strict disclosure rules about what can be disclosed and what cannot be disclosed. And we are subject to all of those disclosure rules both at the SEC and the CFTC.
So you're not allowed to mention the names during
the
flash crash?
The level of detail that we were able to go into was the level of detail we were legally allowed to go into.
Or they want to protect somebody?
I don't know. I mean, I've done all I can do. We took that first step. The first step is that, okay, let's commit a week or two to this. Let's just, get into this. It was being able to commit that time. You learn just enough that, it's just so close. We gotta look at this, and then it really has been like that all the way. I still see the light at the end of the tunnel, but
You almost regret that you started to research.
I'm thinking it's a train coming at me.
Six years ago, there were many trains a day going south from Canada, completely full of lumber, to California to build all the houses that now can't be sold. And now you don't see any lumber going that way. Coal going north to Vancouver and then to China. We like to think, because sort of in our lifetimes, this digital universe has been running faster and faster and faster. Every time you buy a computer, it goes twice as fast. But in the digital universe, there really is no time. The time as we know it just does not exist in that universe. The computer is not operating on time. It just operates on sequence. Something happens, and the next thing happens, and the next thing happens. You ask for the next instruction, execute that instruction, go to the next one. And now we impose, it's sort of like circuit breakers. When we build our microprocessors, we say, okay, you can't do anything until the clock says it's, a nanosecond later and you can do the next step. But the computers actually don't need that at all. They could be totally asynchronous and just, so we sort of imposed our clock on their system.
What is the implication of that?
Well, the implication is that this other world exists now that's not tied to our form of time at all.
What we had found is when markets move fast, a lot of market participants pull back. And while that sounds like a sort of a simple thing, that's pretty much it. When market participants pull back when markets move fast. So how do you solve that? Well, how about saying when markets move fast, we're going to stop the market from trading, to give participants a time to come back in. First, we spoke with all the exchanges, and we met with a bunch of different market participants. And very quickly, we put in what's now been known as the circuit breakers, which for certain sets of stocks and for funds, we paused the market for 5 minutes if the price moves more than 10% in 5 minutes.
But the SEC's circuit breakers, though, these 5 minutes is like an eon and a long time. And, you know, it's set up that people could actually game them and cause delays in certain stocks by just simply forcing the price to go high enough.
It would be, they would do so only if they found that there was a way of capitalizing on that.
If you're the one that causes it, and you know, anytime you know what's going to happen before somebody else does, I mean, that's just opportunity. And so they'll end up being magnets. So when you get like, if it's 10% breaker and you're at 9%, you're most likely going to see that 1% close a lot sooner than it would otherwise.
We operate on this time scale where, you know, where 5 minutes is pretty fast. You could go out for a cup of coffee and come back and find that you'd lost $1 billion. That would ruin your day. And yet for these computers operating in microseconds, it makes no difference. So I think it's the circuit breakers is a case of sort of imposing our time scale on the computing time scale.
Could it happen again?
The same mechanism that caused it on May 6th is still there. In fact, we see it actually occurring more often where there's at least weekly there's a pretty strong move in the E-mini, very similar to the first event. We just don't see them back to back coupled with a lot of bad news.
And we really can't predict because we don't know, for instance, how the algorithms have changed now. Now that, you know, everyone may have rewritten their codes to take advantage of the next time this happens. So the next time it happens, it will be different.
There must be a control room somewhere overseeing everything that's happening on the financial markets. Somebody.
No.
I don't believe there's any Wizard of Oz behind the curtain, no.
There is no air traffic control for the market. And there is no one person or one group that in real time sits and watches and says, wait, that order over there, hold on, let this order go through first.
It's so complicated. Just the volume of data alone is it's so overwhelming that, and the problem is that it keeps growing at this alarming rate.
The technology that would be required and the skill level that would be required to monitor markets across exchanges in multiple places at super high frequencies and know how to deal with it. The technology and know-how is typically not found in governments because it costs a lot and taxpayers probably don't want their money spent that way.
So you won't be able to find people who would be willing to do that work for
for free, effectively? Not so much. I don't think so.
The crash I expected, but not the recovery. It was the recovery that was a surprising thing. How did this thing suddenly go back to a more or less stable state? It is a little scary that we've given these machines so much power over our lives. On the other hand, you can take the other view that machine management of these systems may work a lot better. I mean, that's the optimistic view.
Look, humans are great because we invent things like computer trading strategies and autopilots, but we're not so good at executing a thing over and over, which is why we have machines build our cars once we design them. It's why we have computers fly our planes once we design them and design that algorithm and so on. It's just the same thing applied to markets. Maybe they've watched the Terminator movies too many times, I'm not sure, but as soon as anything sort of slightly odd happens in the markets, it's immediately, let's blame the quants, let's blame the computers. Computers, they do what you tell them. So if you understand what's been told to them, you understand the strategy.
So who knows what's inside the black boxes?
You hope somebody knows, but we don't even know. It's entirely possible, and I'm sure that there are companies doing it that are allowing those algorithms to evolve on their own. Just letting the black box try different things with small amounts of money, and if it works, reinforce those rules. That's been done. We know that's been done. So then you actually have rules where nobody knows what the rules are.
Because the algorithms create new rules for themselves.
Yeah, you let them evolve the same way nature evolves organisms. You say that, well, every 1 out of 1,000 times you change something and see if it works better. And it's amazing how quickly you can evolve algorithms that work better.
If you are an investor, meaning that you wake up one morning and you say, I would really like to buy a stock that I've been tracking and I really understand that very, very well, then you can buy that stock.
Owning the stock market is historically, from the data I've looked at and studied, not been a particularly clever idea for a really long time.
The last time I traded was, I bought Apple in 2001.
I'm not afraid because all my money is in cash, earning no interest.
I don't have a dollar in the stock market, but it interests me. Just as a, so I'm sort of happy when it goes down, and it irritates me when it goes up. Why are these other people making money by not doing any work?
Stocks in the US, just in the last 10 years, have had 2 distinct declines of north of 50%. So to make 5% in a year, you're risking half your money. That, to me, is an awful trade. I don't make it.
Super-quick computers and advanced mathematic formulas have largely taken over trading on the financial markets from human beings. Algorithms, which seem to have a life of their own. Algorithms secretly lie waiting for the moment that your Apple share or your pension money gets on the market. The only ones who understand this system in any way are its architects, the algorithm developers. Chaim Bodek is one such algo developer. After finding some strange wrongdoings, he sets out on a personal crusade against this elusive system. It's a step that goes directly against the unwritten Wall Street code of silence and secrecy. This is what's in store for you.
There's kind of a rule, never blame other people, never blame the market, never blame the other trader. It's always you. Your code, your code is wrong.
If you're on Wall Street, you just assume you're being ripped off unless you're the one doing the ripping off.
You know, on Wall Street, we talked about the culture of secrecy. You just don't go to the SEC.
This is Backlight. Welcome to the twisted nooks and crannies of our financial markets.
This is all about just a 1 cent move in the stock. That's all it is. How a single tick, how a price changes, that's when the game is played. And when that one tick happens, the world is divided into winners and losers.
The machinery behind our financial markets, consisting of mathematical models, data centers, and miles of fiber optic cables, is disguised by technological complexity and secrecy. The builders of this financial system are a new breed of Wall Street employees, quants, mathematicians and physicists who are responsible for a technological revolution. Chaim Bodek is a quant. He specialized in artificial intelligence and worked for Hull Trading and Goldman Sachs. He knows the system from the inside. He helped build it.
One day I got a call that said, hey, you've got to get in touch with this individual. His name is Chaim Bodek. He's got some revolutionary information about high-frequency trading, which is one of the subjects that we cover at the Battle of the Quants. And I said, sure, I'll give him a call and see what's going on. Having Chaim Bodek speak was like opening Pandora's box. And he machine gunned his way through the series of slides with information
that, frankly, I heard back from people in the audience that said they were astounded.
Nobody ever talked about order types until Haim came around. I mean, it wasn't even part of the conversation. And when I, heard what Haim was talking about, he's looking at order types that, if used properly, guarantee a profit.
There were definitely people in the audience that were aware of this and cowering in their seats saying, who is this guy and why would he allow this information to be out and potentially ruin our fantastic, opportunity for generating revenue in the marketplace.
There were actually quite a lot of Russians, and one guy came up to me and he says, I know what you're doing. And I'm behind you, and if you need anybody and you need any help, I've got some friends. And I'm like, am I at a quant conference? And these are just other people's reactions, right? I'm thinking to myself, look, it's a bunch of geeks who did this. I'm not going, I don't think I'm going against like the mob or something like that. Parts.
In 2011, Bodek's own high-frequency trading company, Trading Machines, went under. According to Bodek, the reason was a wrong order type, or the way in which he told the exchange to execute his order.
Well, this isn't the setup I used to have, I'll tell you that much. But, it'll do. When we launched Trading Machines, we knew which machines we were faster than. We knew specifically which firms we were faster than and specifically which firms were faster than us because we traded against these firms.
So you were as fast as the others that were fast?
No, we were faster.
You can take a time frame of 1 second, and it looks as if it's a lifetime of trading between these algos that you never even see.
It was Bart C. Kellerman who invited Haim Bodek to tell his story at the Battle of the Quants, a recurring event where quants discuss high-frequency trading, amongst other things.
When you buy a stock, you buy it at a price, and then for the next person to buy it, they have to pay more. So that margin was the advantage that a lot of these HFT organizations could take advantage of. Now, it's minuscule in terms of the amounts, but when you do it millions and millions of times, it creates tremendous revenue over a period of time. 10 years ago, these quants would write a model, put it out into the market, and basically go to the beach and relax. And they'd come back at the end of the day and they'd count their money.
Bodek wrote an algorithm for trading machines that would generate a guaranteed income, a money machine that weathered the financial meltdown of 2008. But then, from one day to the next, the algorithm stopped working.
I started seeing behavior on certain exchanges that just was odd. You watch this algorithm and it's cannot trade, even though it's moving the price and it's trying to trade. You're like, why can't it trade? No one will trade with it. I'm going back in time and forward saying, what code changed? We have 1 million lines of code. The pattern I'm seeing is completely inconsistent with every single bug I've ever seen in that area. There's kind of a rule, never blame other people, never blame the market, never blame the other trader. It's always you. Your code is wrong. It took 12 months. 12 months from that date until it was explained to me, and it was explained to me by a person. That's why probably why I didn't discover this for so long, as I sat there trying to figure out what we did wrong. went to a holiday event hosted by that exchange, and I say, I'm sorry, I have a bug.
So to who were you talking
To a business development guy whose job is to encourage volume growth at the exchange. That's his entire job. He explained to me that my order was being systematically disadvantaged because I was using the wrong order type. So I'm not going to actually blame stock market asymmetry for what finally killed us, but I will say it did waste 1 year of my life chasing something that I could have learned over drinks.
What was your first reaction?
I was humiliated. I was, you know, how could I not know this?
Bodek thought he understood the plumbing of our automated financial markets, but foundered on the social codes within the high-frequency trading world. Certain traders had found a way to have their orders jump the queue. Bodek started his career with a company that pioneered automated trading. In Chicago, at Hull Trading.
We had a very strict process by which we qualified people to work for us. So it was pretty tough to get a job at Hull Trading.
Blair Hull is a trading legend. A mathematics genius, Hull made his first fortune at the blackjack tables in Las Vegas. With that money, he founded Hull Trading. With his quants, he was at the forefront of the automation of financial markets.
In 1977, when I first went down to the Pacific Stock Exchange, I realized that all the paper that was on the floor did not need to exist. And I figured a good programmer could automate this whole process within a year or two. My vision for the direction of where things were going was right on. My timing was off by about 30 years.
Nobody who joined Hull Trading was looking for that Wall Street job. They were joining because they wanted to be surrounded by really intelligent people and, you know, working on amazing problems. And that, it was not seen as a Wall Street job. I mean, it would never have applied to an investment bank. It would never even have crossed my mind, right? I'm more of like the Google world, not the Goldman Sachs world, even though did okay there.
Our search for the origins of the technological revolution that has taken place in financial markets over the past few decades leads us to possibly an even greater trading legend, Thomas Peterffy.
We have everything here. We have the American flag and nature, and so from 50 minutes from New York on a good day, it's good.
At age 21, Peterffy fled communist Hungary. He was one of the first to see the enormous possibilities of automated trading. With his company, Interactive Brokers, his net worth is an estimated $6 billion. He receives us in his office.
I have the first handheld iPad type of computer that I made up in 1983. That the people used on the floor. So this was connected to a battery, and here you could display options, you know, various strikes and expiration dates. And here were the bids, and here were the offers, and that way our people on the floor could see what our market was. And via these touch-sensitive
It is a touchscreen.
points, it's a touchscreen, yeah.
And we're talking what year?
1983.
And what were other people?
Other people, well, other people used their minds.
So did you patent this?
No, I don't believe in patents. I believe that patents make other people disincentivized in coming up with new things.
So other people were sort of copying you?
Sure, other people always copied me, but that's okay. That moves the world forward.
You could have a computer on the floor in the early 80s, but you could not have it directly connected to a price feed. I had my computer in the office, and I would go up the elevator, get my computer run, come back down, execute trades, and walk around the floor, and then I'd go back upstairs, do a computer run, and come back down. So I couldn't actually have real price feeds coming in. In fact, the first time that we had option quotes on the floor, in order to input the S&P 500 price, we had what we called a human ticker. And that's the person that looked at the screen and put the price up or down to make sure it was the exact same price. These are the rules that the exchanges had to make sure that people did not move ahead with automation.
So we devised a way to splice into the wire that was that the keyboard was connected to, and we put in keystrokes via computer, so we were much quicker without having to use the keyboard, having to have people sitting there using the keyboard. So this NASDAQ official came, and he saw this, and he said, well, you can do that. I said, why not? He says, well, because look at the rule. It says that all orders have to be input by the keyboard. So we decided to build a overlay over the keyboard that had pistons, rubber fingers that would go up and down and type, right? And the only problem was it was very loud. So it was really typing like and so the next time the fellow who comes in again and he hears this crazy noise, and the orders flying in and out, so he didn't know what to do. And he just looked for a while, and then he went away. And then we never heard of him again.
In the 90s, the Wall Street establishment realised it's falling behind in the technological revolution. Just before the turn of the century, Blair Hull sells his company, including his employees, to investment bank Goldman Sachs for $500 million.
Having Hull being acquired for me was like getting in the back door of Goldman, and we kind of joked about it at Hull often. We were all given personality tests, and the personality type I got was basically your mad scientist personality. Okay, what is there a goal here?
We need some more vinegar, Mom.
So maybe it was about a period of 9 months where people were concerned that I was, working at a bank. I spent a lot of my life and my childhood surrounded by physicists at physics labs.
What did your father say when you went to school?
I don't think he was that thrilled about Goldman, actually. People in that world had, were exceptional. I met, I just remember these parties, little get-togethers I go to, and I'm like 8 years old, and this guy won the Nobel Prize, and this guy won the Nobel Prize. Come here, son, shake both their hands. These people believed, and keep in mind, some of them created nuclear bombs, right? These people believed that science was going to make a better world, and that the way to make a better world was to understand and to create and to discover. And I'd say the people in that world would look at the world of high finance and say, if you're that smart, why would you do that? Making more money than the other guy, is that really what genius is about?
The collective brain power of the mathematics and physics geniuses that have chosen to work in finance has led to 70% of trading now being automated and 50% taking place within milliseconds. what's called high-frequency trading, or HFT.
High-frequency trading has nothing to do with economics. It has everything to do with understanding how networks operate, how they fail, how to make them fail, how to make them fail in your advantage, how to make them fail in your advantage without being detected.
Eric Hunsader's company Nanex sells financial data. Out of curiosity, he researches abnormal patterns in financial data flows. He knows what's going on in the financial markets to within a millisecond.
So Eric, where are you taking us?
I'm taking you to the CME facility in Aurora, Illinois.
But the CME is downtown Chicago.
Downtown Chicago as much as the NYSE is downtown New York, right? So it's really all about the data centers. It's where the machines are. I believe that building up here on the left is the CME's data. Yes, it is.
It looks huge.
It is huge. This is where billions of dollars is transacted every day in the futures markets. When you send orders to buy and sell, this is where it ends up.
But what are these poles, these huge antennas?
This is how they get it to New York fast. So if you were to go climb that tower, and I wouldn't advise it, but if you were and you looked straight down where that dish was pointing, and you had a telescope, you would be able to spot the next one.
But I thought that they
Right here
use
at Hertz.
glass fiber to do so. Glass fiber cable.
This is more direct. So speed of light is all about distance. And actually, light travels a little bit faster in the air than it does in fiber. You know, one nanosecond faster, one clock cycle faster is all you need to be. You just need to be faster than the other people. This is probably a big thorn in their side, this relay station here. There's a number of things that can cause loss of signal, like the Fresnel effect, or the atmospheric conditions can change, or some child's balloon could go up at the wrong time.
Bodek's company, Trading Machines, also made money with its ultra-fast trading.
If it was really an equal match, and I had lost fair and square, I would have beaten myself up, I would have nursed my wounds, I would have actually been quite humble about things. I knew, through my own self-criticism, what I had screwed up and what I hadn't.
Chaim Bodek's HFT company, Trading Machines, closes down for good in January 2011.
I'd heard of Trading Machines, but I didn't know anything about Chaim, so I thought, okay, I might as well meet him. So we set up a meeting soon after. This was a few months after Trading Machines had basically shut down.
It was no coincidence that Bodek started talking to Scott Patterson, a journalist for the Wall Street Journal. Patterson has followed high-frequency trading closely for years. Without knowing about each other, Bodek and Patterson had both been looking into the conflict of interest between the HFT industry and the exchanges for some time.
We did meet at Starbucks in Midtown Manhattan, and I remember distinctly at one point near the end of our conversation, Chaim said something about there being something in the market that's rigged, and he thought that it was in part responsible for what happened to Trading Machines.
But I actually had a full organizational chart with every single head count, one of the top HFTs in my bag, and other things that were part of my business intelligence.
And he had done a lot of work on it, but it was very vague.
So you gave him this pile of documents?
Well, I let him look over my shoulder.
I said, you have to tell me what this is. Because so many times in my career, I've talked to people who have said they know about something that's you know, potentially illegal or something rigged somewhere or another. But it's just, I never really get them to go beyond just to something that's really vague. And I remember the first real interview that I had with him at his house, and we sat down, I think it was around 10:30 in the morning, and proceeded to talk for 7 hours straight and didn't eat anything. I think I had a glass of water. And, you know, I just sat back and listened to Haim and took notes for so long that my computer ran out of power, and I had to start taking notes by hand because it all came out.
I'm going to try to explain metaphorically it's really a circus, so I'm going to make it a little bit of a comedy here about what happens, but sadly, this is pretty much the case. We're going to have a concert hall. Let's say it's Metallica. I mean, I like metal music, so Metallica playing at this concert hall. The ticket counter opens at 6 p.m., so I'm going to go and stand in line. But after a while, other people come in after me, and I'm no longer at the end of the line. There are these scalpers. Well, they're in line with me also, okay? I can see them because they're all wearing the same t-shirt. They also have a very, very close relationship with the exchange, you know, with the venue. And what is that relationship? Maybe one of them brings a significant amount, of volume to this. And what does that mean? He buys a lot of tickets. Of course, he sells those tickets to customers here, but one guy brings a lot of volume. Another guy, one of these scalpers, actually owns 10% of the venue. Okay. The third guy, he doesn't have a lot of volume. He's not big on this venue, but he's big on another venue, and he's got a board seat on this in this venue. So there's a very, very close relationship between these scalpers and the venue. Scalping Metallica tickets. When the ticket counter opens, I'm going to equate that to the moment when in the stock market a price can change. And 6 p.m. on the dot, this is what I'm going to witness. Every single one of these guys is literally going to immediately, in 1 picosecond, they teleport, okay? They are all here ahead of me. How did that happen? I asked some of the other people, and they say, oh, they're really fast. I'm like, no, they teleport. That guy was behind me. How does he get ahead of me? There really isn't any difference between an order type and being the guy who wears the t-shirt. You just put a little code on your order and you just say, hey, don't treat me badly, please.
So how did you get in contact with Haim Bode?
I met him at Blair Hall's house. He invited me over to have dinner, and that's when I first met him.
So what do you think of him as a person?
He's great. He understands code, and so we were talking shop within 5 minutes.
When he told you his story, was it something that you also already had noticed in the data feeds that you were getting in?
No. There's no way. We don't know who executes on a quote unless we don't know who's behind each one. Whereas he would know who's behind his, for example.
And he knows on what exchange he's...
He would see well, I should have been the one in the first... I should have been the next one to be filled, but he wasn't. And there's no way to see that.
No, once I was told, it was so easy to figure out the rest and fill in all the holes. But if you don't actually know that there are scalpers out there who are going to use special order types to queue jump you, and then they're going to buy all the tickets, and then they're going to sell them back to the guys in the line. If you don't know that that is a significant amount of the trading that occurs on an exchange, and if you don't know the mechanisms by which it occurs, it's, you believe what you see on the price feed.
So who set this up?
It's not a business guy who designed these features. Only a few people out there who have really have the technical competency to design these features. Less than 10.
10?
Less than 10, way less.
And you know them all?
Not personally. Well, I know many of them personally. I don't know all of them personally. I'm very familiar with their work.
What were the algorithms that you were building at Citadel, and what was their function?
I can't get into that. I'm terrified of Citadel lawyers. So.
Dave Lauer was a trader and analyst at top HFT firms Alston and Citadel. He was asked to testify as an expert at a Senate committee hearing about high-frequency trading. Like Bodek, he is one of the few insiders who has come forward with his experiences.
So at the top you have high-frequency trading and proprietary trading desks in the big banks. That's the main. That's the party that everyone else is trying to serve or be a part of. Underneath them, you have the exchanges, and the exchange's entire business model now revolves around volume. So the exchanges work hard to court HFT to attract them to their venues and therefore to attract the volume. And the brokers are the ones routing orders to the exchanges, and they're making money off commissions from their buy-siders. So at the bottom is the buy side. The buy side are the pension funds and the mutual funds. They're the investors. They're the ones who are actually there because they think that a company has good prospects or good fundamentals.
And so the amount of money that's being made by all these layers, that is what it costs
Effectively, yeah, that's the cost to trade.
When a mutual fund or a pension fund is putting a large order in the market, how is that order being called in jargon among traders?
Oh, it's the dumb money. It's the low-hanging fruit. It's that's dinner. It's the bread and butter. It's all these algos do is try to detect when that's happening. It's all about figuring out when the institution is buying and selling.
They're just waiting for my pension money to hit the...
Yeah, and they're just gonna skim a little bit off the top.
Death by 1,000 cuts. You'll just get picked apart as that order travels through the system. You want to be on the other side of that trade. That's where you're going to make money. It's just how it's been for a long time, so I think most people are just used to it and they don't question it. And they probably just assume they're being ripped off. That's sort of, if you're on Wall Street, you just assume you're being ripped off unless you're the one doing the ripping off.
Basically, the people whose money is in the large pension funds and investment accounts, they do not understand what is happening. If they understood that it is their money, that basically the banks are taking from them and report it as profits, then they would do something about it. But the problem is that it's too complicated for people to understand.
It was kind of a comedy for me when the order type issue erupted, and it was clear how many people did not know that these exchanges offered specialized order type. You're talking about probably 90% of finance doesn't know how the US stock market works.
The exchanges were originally owned by the brokers, and they would bring new companies to market in the exchange in the hopes that the brokers would then be able to market those new company shares to their customers and get a fee for doing that marketing. And those companies would grow, and they'd be successful, and everybody would be happy. What's changed, though, in the whole scheme of things, is these exchanges have now been taken over to a large extent by investors, private equity companies, not necessarily interested in growing small companies and going public, but instead just generating a monthly return. High-frequency trading provides a fee for every trade made. So the more successful and more frequently somebody trades, the fees generated from that went back into creating a profitable exchange.
These high-frequency firms, they thrive on complexity because if, you know, of everyone, they understand it the best. They understand, because that's their business, is to study market structure, to understand inefficiencies in market structure and exploit those.
Exchanges have changed, from places where companies attracted investors to data centers where wars are waged between algorithms that trade with each other at the speed of light. A hidden world where, during a sudden implosion, the infamous 2010 flash crash, $862 billion evaporated within minutes on American stock markets.
Wow, almost 1,000 points. We call this a capitulation. They're gonna probably halt trading. We can't stop the selling.
You know, the flash crash was an event for me that it was a defining event. There was no way for me to ignore that. I was on the high-frequency trading floor. Things were going pretty normal. I mean, as normal as it can be. The market was down 2.5%. There was riots on TV in Greece, and every time they showed the Greek riots, the market would drop a little. And I remember looking up, and just like every trading floor, CNBC is on, and I saw that the Dow Jones had dropped another 100 points. I said, okay, whatever, kept working. A minute later, I look up, and it had dropped another 100 points. I got up off my desk, and I walk over to the futures traders, and they're just scrambling all over the place. They don't know what's going on. They had huge amounts of orders in the market. Everything's going crazy. Market started dropping another 100 points, and the CEO of the firm comes running out onto the floor, and he's just screaming, pull everything, pull everything. So they're just hitting buttons, turning everything off. And so we're all sort of huddled around these two screens. And the one screen is, we're looking at the book. So it's the futures market. You have a set of people that are willing to buy and a set of people that are willing to sell. This is the market. And as we're watching the screen, the orders, they start drifting, like orders are being canceled. And then they start drifting more. And then they start to go off the screen. And then they were gone. There was nothing. There was no market. For moments, for seconds, there was no market. And we're all just sitting there, and you're staring into oblivion. You're like, you have no idea what is about to happen. I was thinking that something terrible has just happened. Something indescribably horrible just happened. The market was gone.
I picked up my phone and called my trading desk, and I said, what's going on, the guys? And they said, well, we don't know. So I said, what are you doing? Are you widening out your markets? And they said, yes, yes, yes. I said, okay, well, that's all we can do. And let's wait until it stops. Yeah. I mean, you get a nauseous feeling. You're worried. You don't know, is the world coming to an end or what's happening, right?
Even 9/11 didn't have that kind of impact. So you just... Things started to return to normal, and the market recovered, and it bounced back, and everyone just kept going. And for me, I don't know, it just changed me. Looking back on that day, I lost faith in capitalism, or at least what we had built to be capitalism, and I didn't trust it anymore. I lost trust. My friend has a PhD in climate science from Harvard, who was working there. There was a PhD in bioinformatics sitting next to me, a semiconductor designer on the other side. Sitting behind me was a master's in math from MIT. And these people are taking their huge brain power and devoting it to making pennies in a high-frequency trading system. And I couldn't justify that anymore, because they should have been doing, they should have been curing cancer or global warming, and here they are, they're making a fortune. And were we making the markets a better place? Were we increasing efficiency or stability? I mean, that day showed me that we weren't.
pick up on Amazon. $9, guys, $9. $1 to $9. $9.
It was support the VWAP and everything, and it just popped. And it just went through its other speed lines. So
this is bad. This is when
it's
you
gonna
know.
Go back up there, I think.
Yeah, this is when you know you stop for the day. Because this entire day we've done all this, right? And this algo has been pretty much max paying down $200. It's up, you know, 471 right now. How many contracts?
What is?
30-70 contract size is kind of good size, but I mean,
It rebalances.
No, I'm saying if it's down direction.
Yeah, she will.
You're dealing with the puts, right?
She will, but this option won't.
Pure question, right?
That's where it's trader guys make more money. Those Amazon. Oh, the market's closed. Hey! I just bought this Facebook and now I got an overnight. What an idiot. Yep. What a herb. All right, so I'm overnight 500 contracts.
What do you think you were doing?
On Facebook.
5 minutes left.
Dude, I thought it was like 3 o'clock, man.
So essentially, we run a hedge fund out of here. We pretty much manage a community of traders. We bootstrapped it from nothing. I'm from Los Angeles, and our head trader is from Boston. We decided to come out here and try to make a killing for ourselves. This is Brian Weiner. He is a former head trader over at Trading Machines, which was pretty much run by this guy right here, Chaim Bodek, aka the Algo Arms Dealer. Okay, that's what we call him here. And he educates us on microstructure, and we use it to try to become better traders.
What I do is I get a kick out of watching these guys beat up the machines, which they can do, which is fascinating to me given what I've seen in this business.
Together with his friends, Peter Zhang rented a loft in downtown Manhattan to start a hedge fund. Recently, they started working with Chaim Bodek to develop an algorithm that simulates the gutsy behavior of a day trader.
Charlie lives here, this was originally, I think it was supposed to be a study. He's now turned it into a rainforest jungle. And he lives pretty well, you know. Obviously, he's got his own fan, he's got his own bathroom, it's cool. Anand, our main trader, he's got the most gigantic room ever. But this is the master bedroom, though, and obviously there's everything here. It's a really big room. He pays obviously the most rent here. So most of the time, like after trading and after being really worn out, we will just kind of crash on the couch, and it's just like, because we're always in each other's faces, you know, this is kind of like where we hang out. It's also where I sleep. This is my blanket right there. Yep. And we should probably clean it up a little bit.
Where does Chaim sleep when he's here?
When Chaim's here, he sleeps right there.
And then it goes down, yeah, it sucks.
No, but I mean, that's the point. And I think...
And you guys would be greedy about deltas.
We actually reached out to him through Twitter, and we talked to him on the phone, and he seemed like a genius on the phone. And when he came in, the first time, we just said, you should just come over. You know, come see our operation. You're going to love it. Let's do some business, maybe. And so he comes over, and he walks in just like full speed in a suit that doesn't even fit him. And I'm like, Chaim, what's going on, man? And Anand has this list. He's got this list, like, questions to ask Chaim Bodek, you know? And I'm like, okay, well, we'll do that. And immediately we notice Chaim does this thing. It's called getting Chaimed. He goes on. And he's just the unleashing of the genius, pretty much.
He's certainly respected. He's very experienced. He's got a very impressive background. But it doesn't take away from the fact that he was a high-frequency trader and his systems failed. So I think that plays a large part in how he's seen by the industry.
You would see things like he's not credible and this doesn't happen or this doesn't happen anymore, but never facts behind him.
After talking to journalist Scott Patterson, who later publishes Bodek's findings in his book Dark Pools, Bodek decides to go to the American stock market regulator, the SEC.
You know, on Wall Street, You know, we talked about the culture of secrecy. You just don't go to the SEC and tell them about the, you know, inside workings of Wall Street and how things really operate. That's just, you're a pariah if you do that.
And I'm thinking to myself, you know, this thing's gonna go away. Someone just has to open their mouth, it'll go away overnight. It's a few lines of code to comment out the primary alphas. It's all artificial.
Bodek's complaint is taken up by stock market regulator SEC. The investigation has been going on now for 2 years. The SEC will not comment on its progress.
The SEC has not taken action, and it's been a couple of years now. And they have certainly shown that the inclination to fine exchanges and to make sure that things are being run as they should be. So either there's nothing going on, or it's so complex that it's taking them years.
There's no question that the sophistication of the trading firms far outpaces the sophistication of the SEC. I think that these are very smart people, and they can go to the SEC and they can explain why they want an order type, why it's helpful for the rest of the market, and sound very convincing, and leave out this other part about how it's going to allow them to, you know, rake up millions in profits every day and guarantee them, you know, could provide guaranteed economics.
I think the proprietary trading firms are using the rules to their advantage. And the fact that we created some rules that shouldn't have been created, and we created some order types that are now being looked at very seriously by the SEC, I don't think you can criticize the high-frequency trading firms who have only played by the rules.
Can we really expect the financial regulators to keep pace with the latest technological developments? The flash crash was followed by numerous other computer-driven technical glitches, like the computer problems during the Facebook IPO. The Twitter crash, when people thought the White House had been bombed, or the time Goldman Sachs may have lost as much as $100 million in 17 minutes' time due to a faulty algorithm. In a world that is enveloped in silence and secrecy, no one seems to comprehend what's going on, let alone control it.
The markets and the interplay in the industry between all these firms with all these very complicated and complex technology systems and how they interact makes the entire system of exchanges, high frequency, brokers, and the interaction between the technology, it makes it a complex system. And so, for example, the flash crash is the perfect example. There is no cause and effect that you can point to. What caused the flash crash is a nonsense question. It makes no sense in the context of a complex system. And if you were to replay the same sequence of events identically, there's no guarantee that it would cause a flash crash again. That's the nature of complex systems.
Is it the correct remark that a lot of insiders don't understand the markets?
I don't think anyone understands what's going on. I think that's another quality of complex systems. They're kind of beyond human comprehension to a large degree, because you don't know, you understand very well what your algorithms are doing and what your technology is doing. But once that starts interacting with all of the other systems out there, it's very hard to know what's going to result from that.
So what did your father say when you told him that you would become a whistleblower and that this happened to you?
You know, it is more consistent with the value system that I was raised with.
He didn't say to you, I told you so?
I do think that it was consistent with his view on how finance operates. When you make the front page of the journal, I guess you're supposed to keep copies. Here on the bottom, for super fast stock traders, a way to jump ahead in line. Look, one thing about the culture in Wall Street is it is I don't think people realize how fear-oriented it is. There's all these people in Wall Street who think that they are so strong-willed and so deserving. But if you go look at a day-to-day, you know, the day-to-day life is constant fear. You're afraid if you're playing the wrong music when you drive into the parking garage.
Literally.
Yeah, it is so, there's so much fear. It's such a hierarchy and such a pecking order, especially in the investment banking world. What I did is the scariest thing and manageable to them, right? The idea of being in financial distress, the idea of having your reputation sullied, being rejected, it's their worst nightmare.
Today's high, it's gonna break yesterday's high. Tomorrow's probably gonna come off.
Isn't there like always a rule of thumb? Don't short on the first down day or something like that?
The only rule is don't be short on Tuesday. That's
Oh,
only,
yeah.
This old broker guy that I walk his dog, he told me that.
The difficulty has not really been being vindicated. I mean, that's actually happened for the last 6 months. The difficulty is what next? Where do I go from here?